Hi, everyone. JD White here. Welcome to the Retirement Cheat Code. Today, we're going to talk about 5 ways that you can create a tax-free retirement. Thank you so much for watching. I hope you enjoy this video. I hope you learned something. Let's go ahead and get into it. So let me go ahead and preface this video by stating that it might not be possible to get 100% of your income in retirement tax-free. That being said, these 5 things can at least help you move the needle in that direction and might actually make it possible for you to achieve that. So, the first thing you want to do is we want to try and get all of your funds into the tax free bucket, AKA Roth. The main reason for this is that there's a lot of things when you get into retirement that are going to be based on your taxable income. Number one, Social Security. The amount of your Social Security that gets taxed as income is based on your taxable income. So if you need to pull money out of your pre tax bucket, it is going to be 100% taxed as income, and your income is now going higher and higher and higher. Well, now your Social Security might be taxed. Oh, and also your Medicare premiums are based on your taxable income, and they operate in brackets just like your taxes. So the more income that you claim on your tax return, the higher your Medicare premiums are. By having money in a Roth, we can actually control some of that. Also, if you want to take trips, or let's say in a worst case scenario, you have a long-term care event or something like that, if we pull money from the Roth bucket, that is not increasing our taxable income versus the pre-tax bucket, we are actually increasing our taxable income. So that's number one. Number two, and this kind of plays back into number one, is that we want to do our Roth conversions before we start taking Social Security or Medicare. And remember, there is actually a 2-year look back on Medicare. So that gives you until the age of 63, where we want to start shifting any money from the pre tax bucket to the tax free bucket by way of Roth conversion, contributions, or anything like that. We want to do that before we get to that point where we're taking those funds. If you're still working, you have a few more options for getting that money in, but that's number two. Number three, don't neglect the taxable bucket. If you recall our video on tax buckets, the taxable bucket is our second favorite bucket. The reason we like the taxable bucket is it does create some taxes. So you're going to pay some taxes in the form of dividends, interest payments, capital gains. However, you have control over that. And your principal, the amount that you've already paid taxes once on, can always come back out tax free. And you could actually use some tools like municipal bonds to create tax free interest. So that's number three. Number four, and I'm sorry, I do a really bad job with my hands. Number four, utilize the health savings account, also known as an HSA. The reason that the HSA is so special is that it actually has 3 tax advantages when it's used right. Number one, the money goes in and it's actually a deduction off your tax bill. So, number one, money goes in, you get a deduction for it, takes money off your tax bill. Number two, most of the time you're allowed to invest the funds within the HSA and you can grow those funds tax free. Number three, when you pull that money out, it's tax free as long as it's used for a qualified medical expense. And the terms of the qualified piece are pretty lenient. So, the HSA, huge tool for you in that tax free retirement. That's number four. And number five, control your taxable income and your required minimum distributions by limiting how much money you have in your pre tax bucket. This kind of goes back to number one. By having money in that pre tax bucket, when we pull that money out, we're creating taxable income. There's something that happens when you turn somewhere between 73 and 75, depending on when you're born, where the government makes you take money out of your pre tax bucket in the form of required minimum distributions. Well, that money is taxable. So when they force you to take money out, they could also be increasing your Medicare premiums, taxing your Social Security. So there's all these spillover things that can happen by having a lot of money in that pre-tax bucket. So that's number 5. Well, hey, if you enjoyed this video and hearing me talk about strategies, tips that I'm using, that my wealthy clients are using, please go ahead and click that thumbs up button. And if you don't want to miss future videos, go ahead and click that subscribe button. I really, as always, appreciate your time, and we'll see you on the next one.